Okay, let's talk about taking the standard deduction versus taking the itemized deduction when you do your taxes. I've mentioned in a whole bunch of different videos tax deductibility when we think about contributions to certain types of retirement accounts or leasing versus, renting versus owning an apartment or house condo, whatever, and the tax deductibility of mortgage interest and real estate taxes and all these different things. I want to delve further into this and explain what do we mean when we say standard deduction versus itemized deductions, with the understanding that this is not tax advice. Everyone's situation is different. You should State tax rules are different in every state. So if you're trying to make a decision for yourself, you should talk to your tax professional or research the issue. We're just going to talk about what are we talking about when we say one or the other. Deductions generally reduce your taxable income. That's what we talk about when we say deduction. So if we just take someone with a hypothetical income of $50,000, if you have $10,000 in deductions, you're quite literally just deducting that from your income, and you pay income tax only as if you had earned $40,000. Quite simply, that's what we mean. Gross income, take out deductible expenses, pay taxes on your actual adjusted income. This is similar but different from tax credits. Tax credits are dollar for dollar reductions in your tax bill. So like the child tax credit. This is very important to understand because just to make this very simple, imagine a 25% tax rate, okay? 25% on $50,000 would be $12,500. 25% on $40,000 would be $10,000. If you deduct $10,000 in expenses, you are saving $2,500 in taxes. Okay, the $10,000 in deductions saves you $2,500 in taxes. If you were to get a credit of say $3,500, it just is a dollar for dollar reduction. So whether you made $50,000 or $40,000, you quite literally are just reducing your tax bill by $3,500. So credits and deductions are two different things. Let's talk about what we mean when we say the standard deduction. The standard deduction is a dollar amount federally that the government says you don't even have to add up your actual deductions. So mortgage interest, all these. You don't even have to add it up. You can just say, give me the standard deduction, and you get it, okay? In 2022, the standard deduction for a single filer was $12,950, okay? So if you say, I want the standard deduction, you don't have to prove any deductible expenses. You just say, give me the deduction, and the $12,950 comes off of your taxable income. For those married filing jointly, so married filing jointly, it's $25,900. Super simple. Now, what does it mean to itemize deductions? Itemizing deductions means you are actually adding up all of the different things that are at least potentially deductible and saying, well, I want to take that as my deduction instead. What are some of the things that can be deductible? What's called SALT, which means state and local taxes, mortgage interest, mortgage I, we will call it, real estate taxes, medical expenses, if they reach a certain threshold of as a percentage of income, donations. There are lots and lots and lots of other things. Losses, actually, let me put this in. Investment losses. So you might go through and you might start adding all this stuff up and you'll say, well, let's see, I paid $3,000 in mortgage interest and I had $6,000 in investment losses and I paid $6,000 in real estate taxes. And then in state taxes, I paid $12,000 and I had $4,000 in medical expenses. and I donated $1,000. So you might add all this stuff up and you've got 18, 21, 27, 31, 32. All of this stuff together is $32,000. Well, given the choice, I would much rather reduce my taxable income by $32,000 than the $12,950. I'm definitely better off itemizing, right? Not so fast. Not so fast. Many of these itemized deductions have limits. For example, part of the Trump tax cuts limited state and local tax deductions to $10,000. That's the cap. Now, I'm trying to remember. I believe real estate taxes are part of state and local taxes. It doesn't really matter for our purposes. The point here is you have $12,000 in state and local taxes. You can only deduct $10,000. You had $6,000 in investment losses. Well, you can only actually deduct $3,000 this year, and the rest has to be carried forward. So just between state and local and investment losses, you had 18. You can only deduct 13. Medical expenses, 4,000. If I recall correctly, and again, what matters is the concept. I believe in order to deduct medical expenses, they have to represent more than 10% of your income. So you might say, well, I had 4,000, but if you made over $40,000, that 4,000 is under 10% of your income. You can't deduct it. Check out whether that's the number. Donations are subject to certain types of limitations as well. So what's important in deciding whether to take the standard deduction or to itemize is not only what amount of itemized deductions do you have, but is the actual amount you can deduct limited by some of these upper limits. The comparison, though, is still that comparison. How does the standard deduction compare with your actual itemized? The report I have is that the standard deduction is selected by 87% of taxpayers. And if it's a very small difference, you might say simply to avoid having to count it all up and track it all, I'm going to take the standard deduction. It's a personal decision. If you take the standard deduction, you also still qualify for tax breaks on certain other expenses. So let me give you an example of that. HSA I'll make this, it's getting very full here. HSA contributions, some retirement contributions, certain education expenses. What else? Maybe alimony payments. There's a bunch of things where even if you take the standard deduction, you are still allowed to deduct these as well. So that's another consideration. Some of your itemized deductions could be added onto the standard deduction. So how do you figure it out? Quite frankly, if you have an accountant, you give them all your information, they will figure it out. They will say, here's your best bet. If you use tax preparation software, you enter in all the information and then the software will tell you you're better off itemizing or you're better off taking the standard deduction. This is the bottom line, the sort of basic introduction to standard versus itemized deduction. Understand it, talk to your tax professional or accountant before making any decisions.